All right. Good morning. Good morning, everybody. So we're nearing the end of the month. It's something to keep track of. It's also, we're going to be getting into the last month of December. The shortened weeks will throw off your options trades. We had a slew of Fed speakers over the last week or so, all saying the same thing. They're going to continue to raise rates, but they are looking to slow down the size of the rate, and maybe the pace of the rate. So what they've been doing is back to back 75, 75, 75. Now they're saying they may back that off to a 50, and at some forward future date, not do back-to-back rate hikes. But they said that all the work that they have done so far has just brought us basically in line with where a neutral rate would be. So if you think about, a line in the sand, consider that the zero line. We were below zero. We were down here. And they want to get into slightly restrictive territory. So they want us somewhere up here. And they said that all of the rate hikes that we've done so far has really just brought us up to the zero line, to the midpoint, to neutral, basically. And they want to get above neutral, right, to get into slightly restrictive territory. So all of the rate hikes that we've experienced so far, those were just getting us up to where we should have been all along. Now they're focused on actually pushing beyond the zero rate, or this hypothetical neutral rate, right? Which is it's a unicorn. It's a myth. It's not a real thing. Nobody can tell you what neutral is. They just have this grass is always greener hypothetical vision of what neutral would look like. And all of the work so far has been to get us back to that point. So we would move forward from here, looking at a terminal rate eventually, say 6.5. I've seen 7.25 from some places, right? And we're still sitting at like 3.75. So the market is trying to choke that down, right? Nibble around the edges on that. It's a lot to take in. It's not new. They've been, trying to get that word out for a while. And this kind of brings up what we're going to be waiting for this week, is we're waiting for Powell. He has this opportunity tomorrow at 1:30 to really do something, just like at Jackson Hole. It was an open forum. There was a few guidelines that he needed to hit, some key talking points, but otherwise the floor was his to say or do what he wanted to do. At an FOMC meeting, he doesn't have that flexibility, right? It may seem like he can just go up and do whatever he wants, but he really can't. He's really restrictive during, congressional hearings. When he comes out doing FOMC announcements, he has to toe the line and toe it really well, right? He deviates just a little bit and he can wipe markets out around the world. So tomorrow he has the latitude to be able to expound upon some ideas. So he could talk theory. He could present, this pie in the sky future model that we're all aiming for. And the scary part is if he still thinks that the markets are too buoyant, too robust, if he thinks that we're still all trying to buy the dip and run this thing up into like a Santa Claus rally, and he wants to shut all that down, oh, he can shut it all down. When I was newer to trading, I couldn't understand why people would talk about manipulation so much. Like, oh, the plunge protection team is going to come out and run that market up or run it down. And I thought, how can they do that? How much money would it take to move this market? But I was looking at it from the wrong point of view. The Fed doesn't have to buy anything to move this market. They don't have to go out and put money on the line, buy into anything or sell into anything to make it move. All they got to do is come out and chip their teeth. They come out talking policy and just give an implication that they're going to raise rates, slow down the way that we're raising rates, reduce the size of the rates when we do raise them. Any kind of language that they want to use, they can move this market up and down. That is where they have the ability and the capacity to drive this market wherever they want it to go. So the plunge protection team is a real thing. It's been around for a long time. And it does not require the government or any of these people that work for the government to actually do anything money-wise. They don't have to purchase anything. They don't have to trade anything. They don't have to put a dime on the line. All they got to do is come out and talk. And we've been seeing that talk. We've been seeing them in a concerted effort, working together, singing off of the same page, all saying the same thing. And if their collective work over the last week hasn't been enough, then we're going to see Powell correct that tomorrow. The last example of this was Jackson Hole, what I call the mic drop moment. He was scheduled to speak for 30 minutes. He spoke for 8, and the markets tumbled for days afterwards. So I'm not saying he's going to drop this market tomorrow. I am saying he has the power to drop this market tomorrow. Of course, he can also spike it up if he wants to, right? It doesn't have to be a down thing. It can be an up thing. Unintentionally, right? It doesn't have to be like he wants to come out and run this market up. But he can say things that the market misunderstands or misconstrues. You know, back in the day, the Fed used to work with the wink and the nod. You had to read between the lines and try to infer from their statements what they really meant, wink, wink. Now, they've gotten better over the last decade about just flat out saying it. But then they also started bringing in this extra communication when they would start talking about having a talk about raising rates, right? And then they would drop one of those off and it was just, we're thinking about having a talk about raising rates. And then it was, okay, well, now we're going to raise rates. Right? They would bring in these extra modded steps that they could point to a specific phrase and say, see, we're 3 steps away. Now we're 2 steps away. Now we're 1 step away. Now we're raising rates. They've got a communication situation, right? Obviously, they're working on it. The only thing that this market cares about right now is the data points that the Fed is going to use to make decisions about the rates that they're going to bring in. That's it. Nothing else matters. On the side of that, the only market in control right now is Apple. If Apple dumps, this entire market is going to dump. If Apple holds the line and continues to maintain within its structured boundaries and maybe even rallies up, so will the market. So a strong drive from Apple upwards will drive the market higher. Apple breaking loose and heading to the downside, going to take this market with it. If it just continues to chop around and not really drive forcefully higher or break structure and head lower, then the market, the rest of the market can do what it wants without that interference of Apple. So that's it. You got the Fed and any data points that the Fed will use, CPI, PPI, job numbers. You got the Fed in their data, you got Apple. And I would like to expand on that a little bit, right? I have something more than just those two, but we've seen moves even in the dollar in the last 2 days. And the market just shrugged like, whatever, screw the dollar. It took a really, really strong move in the dollar yesterday afternoon. And I mean, really strong move for us to finally actually see any kind of reverberation through the rest of the market. It's an old phrase I used to use: apple is spy and spy is apple. And that's as true now as it was then. The market pounced on just the slightest bit of news coming out of China. And it wasn't even COVID restriction reduction. It was just the wink that China might slightly work a little harder to give their elder citizens access to their vaccinations at a faster pace. And their market buoyed strongly to the upside. That's not much of a give when you think about, you know, the government over there. So I would still be very careful with the China ADRs. This is, you know, fear and greed drive the market a lot, and unrealistic fear and greed can drive us really hard, really fast. The kind of moves that we saw in China on this news is, it doesn't fit, right? It's like an overreaction. So proceed with caution on those ADRs. PDD had a really nice earnings, and last I seen it was up like 16% yesterday. An absolutely amazing move in PDD, and that helped too. But I've seen a lot of unusual options activity on KWeb and JD and a couple of other big China names that we would normally look at. And they were like put sweeps, right? So positioning for a downside move. We got a lot of Bank of England speakers today. No US Fed speakers on the docket at this point. We have additional auctions today at 11:30, but once we're through with that, say by noon, we're good to go. Right. So if you were looking for 0 days this afternoon, there's no econ really standing in your path. You have a free move there. So I'm on a weekly chart. That was a good place to start. There is a lot that goes into a morning briefing. And the reason that I've been doing these morning briefings live every day is because when I tried to teach how to do a morning briefing in a video, the video was really, really long. And it was just a bunch of data points to look at. And I had a feedback from people who said it's too much to remember. I need some other way to learn it. Okay, well, we'll just do it live every day and teach the process of how to build your own morning routine. Doing a top down on the charts is a part of that morning routine. You can start as high as the quarterly level, drop it down into monthly, weekly, daily, hourly, 15-minute. Now, obviously, those quarterly charts, they're not going to change on a day-to-day basis very often, right? And the monthly ones, they're not going to change. So we get into the habit of not going out there every day because, well, it's the same candle that we had yesterday. Nothing changed. One of the things that it's worth adding to your morning routine is that you have something to say about every chart you look at. Write it down in your notes. One sentence at least for the quarterly, the monthly, the weekly, the daily. One sentence for every one of those charts. By the time you're down to your 1 hour chart, you've got 5 sentences. That's a paragraph. You should be able to reread that paragraph and have a statement about where the market is today. Are we going to hit a major moving average if we continue moving in the same direction? Have we just hit a major moving average and we turned and are moving in a new direction? Did we break a level? Are we about to break a level? Are we getting to a level? These kind of notes prime you and set you up for the trading day so that you have something to watch for. You have something to wait for. You have something to plan on. It's a little bit of work, but that work is the difference between a successful trader and an unsuccessful trader, and being able to put real large amounts of money at risk versus the little nickel and dime penny ante trades that keep you engaged in the market but aren't really changing your portfolio size on a day-to-day basis. Because when you don't have conviction, you can't size up. And if you can't size up, then you're just taking these tiny little trades, wasting your time. And of course, you're going to get a big loss. So a bunch of little wins, one big loss wipes out all your work, start all over. We're on the weekly because for weeks now, we've been saying we're on hold. We need something to happen so that we can call a direction. Are we going to go up? Are we going to go down? Are we going to go up? Are we going to go down? The answer is still the same. We're sitting in the range that we've been sitting in. It's IX10 inside week. Now we do have a gap down and we haven't resolved that gap, but we've got others on the chart. So it's not something that's never happened before. And that can stay unfulfilled for a long time. It doesn't have to be filled this week. But we're still in the range. Nothing has changed yet. So we don't have any signal to go long, and we don't have any signal to go short. And the best trades right now are the ones where you make money if the market doesn't do anything. And it's a reasonably decent range. So any trades to the upside or the downside, without seeing the market leave this box, is nothing more than a guess and a gamble. We don't have a signal to do anything else. That is a rising wedge, by the way. And while it doesn't always unfold this way, if you have a rising wedge, you measure the peak where it breaks, you plot that distance. Rising wedges tend to break to the downside. Although sometimes you get the fake breakout first. You get this blow off top move and then it dumps. But it still dumps either way. It's what rising wedges do. The volume is within our normal boundaries. It's right where it should be. We're inside day. We're inside week. We have the daily pivot point within our structure. We've crossed through it a few times. And we are underneath the weekly pivot point, which automatically puts us in a bearish state. We are very close to the edge of the expected move. We got there yesterday, went through it, and came back up above it. This is the size of our expected move for the week. 39.67 and 1 tick is the low end. We can wick out of it. We can close out of it. We can leave the range to a degree, and it's not that bad. But this is a 1 standard deviation move. So we'll just nerd out here a second. A 1 standard deviation move is not a big deal. If we were to move a 2 standard deviation outside of that range, so we get to the edge and we move 1 more standard deviation beyond that, it will fire the algos and they will start to sell into selling if we break to the downside, because they're going to be working to get back to delta neutral. And the more we fall, the more they will sell to get to that delta neutral space. Of course, the more they sell, the more we're going to fall because they're selling. It's going to drive the market lower. And it creates this volatility loop. Same thing if we break to the upside. We're not anywhere close to breaking out of the upside, but it would be the same mechanics going the other direction. So just the fact that we went through the bottom of it yesterday doesn't really mean too much other than, as a standard deviation model, we should close inside of that box 70% of the time by default. And implied volatility is overstated. So even though we should do it 70% of the time, we actually do it more than that, 75, 77, sometimes 80% of the time we're in that box. But see, during a bear market when volatility is really high, we actually do the other percentage. So if we should close inside 70% of the time, we're in the other 30%. We're in the time period where we close outside of it a lot. And this year has demonstrated that frequently. There's not a lot of consistent back-to-back weeks where we stayed inside the box. If you want to do some averages on that, the easiest thing to do is just count back the last 10 weeks. How many weeks out of the last 10 did we close inside the box at the end of the week? It should be 7 out of 10 times. That's normal. In really good times, 8 out of 10, we closed inside. So we tagged it, we left it, we came back inside of it. Everything is fine. In a normal environment, that would have been a trigger to go long. It's one of the 18 strategies that I built to trade using this indicator. That when we get to the edges on a Monday or a Tuesday, by default and just automatically, we take a trade in the other direction. We could do it, buying calls, putting on a put spread, a put credit spread underneath there, a call debit spread, anything like that. These aren't normal markets, and I don't run those automatic strategies in these conditions. Still, at the very least, it should have been a little bit of a heads up that we had moved the entire week's expected move in a single day yesterday. Almost too far, too fast kind of a thing. And now we're whipping back in the other direction. Very much like a bungee jumper who got to the end of their bungee cord and got yanked back in the other direction. $39.90 is our own Globex high. We'll call it 4,000 for the cash open of yesterday. There is the Globex low of 39.92. Then the weekly pivot point 4,007, ADR half at 4,009, the COG line at 411, 4011. The high of yesterday, 40.24. The ADR full, which is really close to the previous week's high. And we still have that gap close on the table that needs to be resolved. Depending on where you want to start it, it'd be 40.34. So we got a lot of pivot points to the upside. For the downside, $39.72 is the Globex open. The low at Globex, $39.68. Call it 69. Low of yesterday, $39.60. The previous week's low, $39.37. ADR half, $39.34. And then the ADR full at $38.98. Now these distances may seem really far away. I'm going to just kind of zoom out a little bit. They may seem really far away, but it's because of the size of the candles that we've had, right? We've had all these holiday shortened week and holidays and all of that. And the market's been waiting on econ, and it's been waiting on the Fed, and it's just been a whole lot of waiting. So these metrics are designed, at least mine are, on a 21-day ADR. So an entire market month, 20 days. But in the last 10 days, we've had some reasonably small moves compared to what we've seen, through the rest of the year. Volatility right now says that our daily range just for today is like 50 points. And the range for the week is 100 points, right? If you was to go and put on, say, an implied volatility indicator, $51.64. Of course, you can't do 64 in the ES, so $51 and 2 ticks. But look at the volatility, right? It's very flattened out, really, really low. It's just based on all these little candles that we've had in the last few days. The thing is, we learned from the RSI Laguerre that a market going sideways is actually not just sitting around doing nothing. It's building up energy, which is a weird word. We don't normally use the word energy. We use inertia, trend, and momentum, and that kind of language, not energy. But different ballpark, right? Different game when the RSI Laguerre came in. So this market is building up energy. That's part of it. It's also building up open interest on each side. So there's a lot of open interest to the upside, and there's a lot to the downside. The longer we stay range bound like this, the more these orders are just going to build and build and build and build and build. So that when it does break, one side's going to get squeezed in an epic squeeze pattern, which is why when I was talking about this rising wedge and that blow off top, that we might break up first significantly before we dump down. And that's because if we do break out of the top of this range, we're going to trigger a lot of orders that are sitting up there. Anybody who's short has to buy to close. Their buying is going to add to the buying, and it will just be this horrendous buying. Plus, we're all waiting for the end of the year rally, right? So it's going to trigger a lot of FOMO players. Everybody's going to think, yes, we're finally going. And it's just going to be this epic blowout to the upside. Doesn't mean anything on its own, right? Because it can still flip and dump anyways. Same thing to the downside. Which is why you get that pattern, the megaphone, right? Where price expands just a little bit more each time, where it's going just a little higher and a little lower, but it keeps reversing and coming back in until finally it doesn't. And you get that final breakout. So we're tightly wound this morning. We've got a very narrow range. The initial balance is really low. It kind of implies that there is still a lot of work left to do. But with the PAL event tomorrow on everybody's minds, and it's getting hyped up really big. Remember, he doesn't have to do anything. He doesn't have to come out and move this market. And a lot of times during his FOMC announcements, what he used to do and what we used to joke about is his entire job was to not move the market. Operation Don't Rock the Boat. Come out, move your mouth. Words fall out, but they're all meaningless. There's nothing that we can act on. And he finishes his interview and leaves without ever having moved the market at all. That is normally what he tries to do. So there's no promise or guarantee that tomorrow he's going to come out with an agenda to deliberately move the market anywhere. He might come out with an agenda to not move the market at all and to say a bunch of words that have no impact or bearing or meaning on anything that we can't use to do anything. And it's just another theta burn. Right? We're just melting away this premium on those options, not doing anything, not going anywhere. Ten-day, 30-minute volume profile. There's nothing here of value. This is like a D shape value, right? The volume profile has a B and a D and a P. Then you've got your lowercase b, right? You got all these different patterns that this profile could make. And we basically have a D pattern. So the entire thing is just one big volume chunk of trash that has no bearing, no merit, no value, nothing that we can get out of it, other than it has a point of control, which we found already, and we were at the high. We're making our way down to the low. Just remember that that low will move, right? This entire profile will move. As more of these candles on the back end drop off, this volume profile will shift and adjust. All right, but when we're at the lows, we say we're going to the top. When we're at the top, we say we're going to the lows. If we break out of the box, we say we're working to get back inside the box. So the other day I mentioned we were at the top, we're working our way down. We are still working our way down. On Thursday, we will lose the rest of this. And if we have not set new lows, then our volume profile will be a lot narrower come Friday morning. Everything just getting more and more and more compressed. We have nothing to carry forward from yesterday on a day-to-day volume profile. You could bring the value area high and low, but it's basically yesterday's high and low, so there's no real value out of that either. So I mentioned finance yesterday and made the distinction or pointed out that this is something you're really going to want to keep your eye on because the dollar wasn't really helpful yesterday, right? So we needed something else. We have the weighted advancing and declining issues, like my Thinkorswim. Thinkorswim wants to be a quitter today. So on the advancing versus the declining issues yesterday in the NASDAQ, before we finally broke down, I took a picture of the money. We had a 70-30 advance decline. So 70 names falling, 30 advancing, and yet the money flow was almost exact, right? The same amount of money was going into the market as was going out of the market. And that didn't make sense because we had, 100% more names going down than up. And that was right before the breakdown. So the New York FANG, basically big tech, right? The monsters of tech. We had that little loop-de-loop, and then it was just sideways all through the day. And yet the financials kept trending lower and lower and lower and lower until it finally broke a major trend line and dumped down. Market breadth continued all day long, just heading to the downside. No change at all. The ticks all day yesterday, the higher time frame ticks as an average, it just kept ticking lower and lower and lower. So market breadth from those two places were doing nothing but declining all day. And the advance versus the declining issues also really didn't do anything more than decline all day. But it wasn't until the later part of the day that we finally broke a major level and then dumped. But the financials matched the market breadth and the advancing and decline 100%. The big tech didn't, right? It wasn't continuing to trend lower. It was holding the line. I don't think we're done yet with finance either. So I would continue to watch those. On the weighted advanced decline, it was a slow grind all afternoon until it got to my benchmark minus 500 and broke, which was a nice trigger to go short. I kind of jumped the gun a little bit and got in early, but it was a nice play to the downside. And the ticks never got extreme. We never did get to a minus 1,000. It would have been nice, but we started getting multiple tests of the 750, 800 area. And we had a dominant, consistent, persistent trend in all of the market breadth. It's about as good as we could get, right? Because if you look at the pairs and what was going on in the dollar, it wasn't getting a whole lot of help. The dollar was making moves to the upside all day yesterday, but the S&P and the NASDAQ were not breaking down. They were kind of just holding, right? Until finally the dollar broke out and just went kind of blow off top, crazy parabolic. Then the S&P and the NASDAQ broke down. But it took a very extreme move in the dollar to see anything reverberate back against the NASDAQ and the S&P. So we can't look to the dollar to be as useful as it has been. And we need to focus on new data points. Continue to watch US dollar, China, and Japan, seeing if they're coming into major levels of support or resistance to kind of help with what's going on in the dollar. Is the dollar going to hold here? Is it going to rally here, fall here? The VIX, it's getting a little bit better, but it has a long ways to go before I think it's going to be useful again. I see United Health has earnings revisions guidance. That'd be something to look into. It absolutely has the weight to move the Dow. And we've been watching the Dow close. It's at a major resistance. The Dow is really poised for a make or break moment, and UNH most definitely could be the breaking point. Roku down 3.25% this morning. SI down nearly 3%. Just kind of tagging on some of these names that I know that are worth digging into. PDD, that's a surprise, continues in that upside move, another 5%. I almost shorted this thing yesterday just because it had already made such a drastic, extreme move, and it's primed up for an island reversal play, a really nice island reversal play. But I didn't do it because back here, it had a really nice island reversal setup, right? It was down here, it gapped way up here, and then it ran even more and then built the island and then dropped back down, right? So I was a little concerned of this happening again, so I did not short it, but I still like it. Only, you know, right now we're like close to 78. So this morning we're up here and it's looking very much like a continuation, at least for a little while more, like we had back here. So I still see this as a great shortable opportunity, but not yet, right? And if it's going to dump, it's got a long ways to fall. So there's no reason to jump the gun and assume that it's done. Let it finish, roll over, and actually give us a short trade, right? So for the moment, I am not ready to short this thing. We got Baidu with a significant gap up this morning as well. As you can see, gapping is its nature. Generally speaking, I don't tend to trade things that gap a lot, especially when they have, you know, unrealistic gaps, just random out of the blue stuff. This gap is not random or out of the blue. We understand why it's happened. It ties in with the whole KWEB thing and how I started the briefing this morning, talking about the market's reaction to even the slightest bias reduction in the COVID zero policy, right? They didn't really do anything. Their language changed. And that's all. That's all it took. And we had this unrealistic explosion. So all of the China names, those China ADRs, PDD, Baidu, Baba, Neo, kind of, you know, JD, they are all still sell the rip plays, not buy the dip plays. Having said that, though, in the short duration, we have seen a lot of buying from the China banks. They were ordered to buy, so they didn't have a choice. They just had to buy. And sure, that brought us up off the lows a little bit and a lot of those names, but it didn't have a sustained follow through. In global trading, China is the place that everybody's looking at for next year. If you read articles across the board from Wall Street Journal, Bloomberg, New York Times, it doesn't matter where you look. Everywhere, when they talk to investors, everybody's looking at China reopening, which is why any slight, even just a change in bias, and everybody's pouncing on it hard. So that makes trading short any of these names a really dangerous thing. When China does reduce that COVID zero policy, all of these China ADRs are just going to explode to the upside. Baba, Baidu, a lot of them are all gapping up, right? If you go and read the article or just the 5 things you need to know from Bloomberg, the first thing that it talks about is how much China's stock market moved while we were sleeping last night. So of course, all of these China ADR names are just getting this explosive move this morning. And the only thing that the China government changed about its COVID-0 policy is that they're going to work harder at vaccinating their 80-plus-year-old citizens. That's it. They didn't say they were going to reduce anything. They didn't say they were going to, level restrictions at all. Just, oh, well, we're going to work harder to get vaccinations out. Boom, there went the market to the upside. Seems a little unrealistic. And Bitcoin names are up this morning. If you remember my list of Bitcoin names, they're not all names that you would instinctively apply to Bitcoin right off the bat, right? Like AMD and NVIDIA. So as a space, the crypto names are doing really good this morning. PayPal, NVIDIA, AMD, Square, although technically Square needs to get into the game a little more before we would look at that one. I had already mentioned SI. Trying to come back around. So we use KWeb to keep track of a lot of those China plays. If you listen to Bloomberg, they watch BABA, right? As not like a tradable thing. They watch BABA like an indicator. Oh, BABA's gapped up this morning. China must be doing good today. Or it went down this morning. China must be suffering today. I like to use this. It's an ETF. It's a basket of stocks. It looks more than just one name, right? But all those names are still in the same category. So it's still an isolated snapshot of the China market, not, it's not doing everything. It's just one area. Still, when this is up, a lot of those China names are up and they become a nice play on the day, right? So KWeb is up significantly. That's 2 days in a row, right? If you think about how yesterday we opened gapped up in that, and we spent the day fading down because we gapped into resistance. But like a market usually does, if it doesn't make it through the resistance in the regular hours, it'll jump that resistance in the middle of the night. And that's what we had here. And we rallied into another resistance level. So these rallies into resistance are eventually going to get a rejection. But as I mentioned, with global investors everywhere are looking at China as the play of 2023, right? Because when it does reopen, and it will eventually, when it does reopen, it's going to be an epic moneymaker across the board, and nobody wants to miss out on it. So money continues to flow into this while they continue to go on TV and say, oh, China's uninvestable. We continue to hear those words. Oh, they're uninvestable. That's what they're saying, but that's not what their money is positioned to do. So we want to pay attention to what the money's doing, not what their mouth is saying. The FXI is an ETF that is kind of a proxy for US dollar China. If US dollar China is going up, this proxy ETF will go down, and vice versa. So we're not really getting anywhere this morning, except that we've got this wedge and almost a classic bear pennant sitting down here, right? Now, the thing about a bear pennant or a bear flag, either one, is when I was studying ways to identify, if it was going to fail or not, and looking for opportunities for if it did fail, I came up with a strategy called the failed flag play. If this was to continue moving in the right direction, it would continue to go down. That's what it's supposed to do. So failure would be that it actually goes the other direction. It failed to continue, and so now it's moving in the opposite direction. You can play this as a bull flag failure too. If you find one, you have a bull flag somewhere and then it fails, you take the run to the downside. I never play that way. I always like playing this way, the upside move. But should we get the breakout here in US dollar China and we start to see that reciprocation to the upside, this ETF is very likely going to continue that move to the downside, right? And trying to play FX pairs without a Forex account, this is the best way to do it, right? Obviously, you can get a Forex account. That's not a big deal, but PayWeb, EEM, those kind of represent both of the same thing, a perspective on China. Yesterday, energy was a little wonky. We're starting to see a divergence between crude and XLE, and it's widening out more and more, right? But XLE is not crude by itself. It's just the idea that those technically should be kind of trying to move in the same general direction. And it's the disparity between those two is getting a lot bigger. So it really is kind of a hurry up and wait situation this morning. Everybody's got their eye on Powell tomorrow. I don't have the stats for it, but I would be interested to know how many Decembers we had where we didn't actually get anything at all. All right, everybody's looking for this big move, but what if we don't get anything, right? And we just spend the rest of the year in this sideways state of nothing. Because it doesn't owe us anything. We need this zone to be resolved. Like, it all comes down to that right there. Until we get out of this box, we don't know if we're going to, reset those lows or we're going to test this pivot point over here, that August rally pivot point. But those two are what's on the table. We're either going there next or we're going down here next. But we're right in the middle. And we honestly, seriously could move either direction. I've even heard people say both, right? That we run up and tag this top and that we drop down after that, or that we drop down and bounce off the bottom and then run up and hit the top, which that one seems really far-fetched. But popping up first and then dumping does not seem out of line to me. It doesn't seem far-fetched at all. But we need to resolve this situation first to make a good trade, a good swing, solid swing in anything. It's really hard to want to allocate a lot of capital into a good swing until we start to break one direction or another. Yesterday, we built a trade idea. It was a back ratio trade in Tesla. And we were talking about the opportunity to short this thing yesterday as it came up into this high. And the argument was there's no better place to put on a short trade than right there. Because if it didn't work, that's the least amount of loss you could take, right? Like it's a low risk entry trade. This going short here didn't guarantee you were going to win. It just said if you're going to lose, this trade would lose less than the rest. And it turned out to be a really good trade, depending on, if you just bought the put or put on the back ratio trade. The back ratio trade needs a little more time, right? It's not going to be done yet, but it has a topside break even of like 205. So as long as we stay below 205, that trade's just fine. There's nothing wrong with it. The point is that was a really great place to take a short. And we were having that discussion, on the idea of a low risk entry trade. Well, that only works if you've got good money management, right? When it comes to trading, you can either jump in early and not wait for confirmation, which is a choice that has consequences, or you don't get in early, you wait for confirmation, and then you get in, and that choice has consequences. The consequences of waiting is that you're going to miss a lot of the move, but you won't lose as often. The consequences of getting in before it's confirmed is you're going to get the bulk of the move, but you will have more frequent losses, right? But losses aren't the game. We're not trying to win and lose. We want to keep the losses small and the wins big. So frequent losses isn't the issue unless you can't manage your money. This is a low risk entry trade so that if you're wrong, you lose, you shrug, and you move on because it's a small loss. Like, well, it was a good shot. It's a good place to try. No harm, no foul. And you might lose 6 of these before you get 4 really good wins. But those 6 losses are supposed to be small enough that the 4 wins that you get way outshine those 4 losses. If your money management sucks and these losses aren't low risk losses, but instead big losses because you didn't manage your money, this is a trade strategy you can't do. So look at your own ability to manage your trade. If you suck at money management, don't do these low risk entry trades. Wait for the confirmation and trade those. Those have a more defined exit on loss. They're easier to play and they're easier to journal and quantify and measure, and they're just easier. All right, so for Tesla, we still have a channel bottom down here at 170. It's the gap close, and it's the channel. And we still have one overhead as well, right? One way up here. So we're kind of trapped between those two. And this needs to be resolved. The easy money, and I hate to use that phrase because I don't like it, but I continue to hear it everywhere. And if you keep hearing it, well, it just kind of seeps in. The easy money's already been made. The simple short has already been hit. But the longer term trade here is still to the downside. Tesla's longer term uptrend is broken. That is done. So we're still grinding to the downside. There's a lot of room left to go. It's just not going to be a straight line. It's going to be a longer term thing. So trading puts like longer term, not necessarily a leap, although that would fit the discussion. You're better off doing that in a naked put, buying a put, right? It's as simple as that. Just buy a put 6 months out, 9 months out, because you can defend that. It's easy to defend a long put. You could just sell a put in the front end. But if you get a put spread, like a put debit spread, there's not much you can do to defend it other than try to, roll it, adjust it, kind of screw around with it, because it's already doing its job. It's giving you an entry and defining your risk. Your risk is already set and defined for you. If you just straight up buy the put, there's going to be a lot of premium in that thing that's going to decay. So you need big moves to kind of offset all that premium decay. But if you're going out, 2 or 3 months, the decay won't be quick. Theta decay is really low, really far out. It picks up speed as you get closer to the expiration. And you can defend it just by selling puts in front of it, which will help you with the temporary rallies and the short-term rallies that you're going to get in anything that you're trying to short, because it's not going to move in a straight line. It's not just for Tesla either. You can do the same thing in Microsoft, Apple, all of these big names that we're all still waiting for the hammer to drop. I'm short Apple. I'm short Microsoft. I'm using March right now. March has reasonably decent options, at least at the time that I got into them, which was, like 6 weeks or more. It's been a while. I've been in there for a bit. We're just looking for Apple to really break down. And, it continues to hold up. It continues to struggle against that really big breakdown. And I'm still short. The only reason that I'm able to sustain something like that, to be long-term short in a market that continues to go against me, is because it's just a put. It's a naked put, and I can defend it. Sell puts against it. So it's something to consider, right? If you're looking for swing trades in some of the biggest names, NVIDIA, Tesla, Apple, Microsoft, those holdout names are not going to give up the ghost easy. They're the darlings, right? Apple's the darling of Wall Street. They're not going to dump this simple and easy. So rather than trying to struggle with shorting these names using complex spreads, you could just buy the put and then defend it. And the same thing, if you think we actually are at a bottom and we're going to get a rally up, just buy the call. There's no reason to put on anything complex. Just buy the call. And if we don't rally, sell a call in the front end to defend it. But you have to have enough space in there to do that, right? If you're buying options 30 days out, there's not a lot of room in the front to get your money back. So if you go out, July or August, right now I'm in March, and that's, kind of pushing it now because we're getting around 100 days. But when I got in it, there was a lot more than 100 days left. You have to have time to make this money back. All right, so for your positive plays, it's energy, gold, Bitcoin, and China names. I really don't see that's going to be enough, right? So we very likely could see a hold the line day where everybody is just looking at tomorrow and Powell. But just like yesterday, if we do start a breakdown, it should be fairly obvious. And, we can run it to its measured move. Apple was like one of the greatest examples of that. Look at that nice, clean breakdown yesterday. It was very obvious when it gave up the ghost and finally took it. So I think it'll be a lot like that today. There's no econ this afternoon once we get past the auctions. So your 0 days should be directly tied to the idea that if we break down, it'll just be one more measured move, and then we're going to hold the range until Powell tomorrow. This is the range we're expected to hold until Powell. And it's a pretty good size range when you think about it on a day-to-day basis. 3,900 to 4,000. So 100 point move. There's a little extra on there, right? About 20 points extra. But that's it. That's the range. Everybody have a good one. We'll see you tomorrow.